All right, John, today we are getting into the real engine room of investing. I mean, for anyone who's serious about picking individual stocks and not just, throwing money into an index fund, understanding the price to earnings ratio is completely non-negotiable. It's the bedrock.
And listen, I'm not being dramatic here. When we say it's the single most important math equation in your toolkit, we absolutely mean it.
Yeah, and I'm ready for it, Steve, because I see that PE thing on my Schwab screen all the time, right there next to the stock symbol. But if I'm being really honest, I think a lot of us, myself included, kind of just glance at that number without really, truly getting what it's telling us about the company.
And you just hit the nail on the head, John. It's all about valuation. You see, the PE ratio is simply how we measure a company's current stock price compared to how much money it's actually making. Without it, you might look at a $10 stock and think, oh, that's cheap, compared to a $500 stock, but that tells you literally nothing about the value. PE gives us a level playing field, a common language to compare apples to apples, even if their stock prices look worlds apart. So when you look at the formula, it seems almost laughably simple, right? Price divided by earnings. But you can't let that fool you. The power behind this simple division is it's profound. So let's break it down with a super clear example, just to build a solid foundation.
Okay, let's dive in. Let's just invent a company. We'll call it Company X. Now, imagine that the market, that's all of us, millions of investors buying and selling, has decided that one single share of Company X is worth $100. Right now. That's our P, that's the price. Simple enough? Now, for the other half of our equation, the E for earnings. So we look at the company's books for the past year, and we see that for every single share out there, the company made $5 in profit. This is what we call earnings per share, or EPS. This is the real muscle of the business, its actual ability to make cash.
And now, we just do the simple math. We take that $100 share price, and we divide it by the $5 in earnings. What do we get? We get 20. So we'd say that Company X has a PE ratio of 20. Easy calculation, right? But what on earth does that number 20 actually mean? Okay, so there's the number, 20. But my question is, what does that really represent for me as the investor? I've just paid my $100. I know the company made 5. How do I use that 20 to make a smarter decision? What's it telling me about the price I'm paying for those profits?
Wait, let me see if I'm piecing this together the right way, Steve. Does that basically mean I'm paying $20 for every single dollar of profit that company makes? Is that the right way to think about it?
John, that is precisely the right way to think about it. Spot on. In the finance world, we call the PE ratio an earnings multiple. In our little example, you are paying a multiple of 20 times what the company earns in a year. So, and this is the key, you're not just buying a stock. You are making a very conscious decision about how much you are willing to pay for that company's proven cash-generating power. Okay, that clears up a lot. But it also brings me to the big problem I always have when I'm scanning through lists of stocks. I see these huge differences in PE ratios from one industry to another, and that's where it all gets a little fuzzy for me in the real world. So, for instance, let's say I see some hot tech stock with a PE of like 80, and right next to it is a stable, boring old bank with a PE of 10. My gut just screams that the bank has to be the bargain, right? I mean, I'm only paying $10 for $1 of profit versus 80, but it can't possibly be that simple. Is the bank always the smarter buy?
Not necessarily, John. And this is maybe the most important takeaway of this entire explainer. The PE ratio isn't just a report card on the past, it's an expectation engine for the future. A crazy high PE of 80 means the market is betting on massive future growth. Investors are willing to pay 80 times what it earns today because they believe those earnings are about to shoot to the moon, making today's price look like a bargain later. On the other hand, a PE of 10 for the bank suggests the market sees it as solid, predictable, but slow. The expectations are low, and so is the price you pay for its earnings.
Wow, okay, that makes so much more sense. So when I go back to my Schwab account, I shouldn't see PE as just some random number. It's actually a tool I can use to figure out what the entire market is thinking. So how do I put that into practice?
Exactly. And here's the playbook, a 3-step framework you can use every single time. First, like you see here, you have to compare a stock to its peers. Don't compare a tech company to a bank. That's apples and oranges. Compare it to other tech companies. Second, inside that group, you start to assess the value. Is its PE on the low side, maybe suggesting it's on sale? Or is it high, maybe overpriced? And finally, this is the most important part.
You have to gauge the expectations. You ask yourself, does the growth story that's priced into this number actually seem realistic? Do I believe this company can pull it off?
So I'm not just hunting for a low number. I'm asking if the price I'm paying is fair for a story about the future that I actually believe in. That's a much more powerful way to look at it.
And that right there, that perfectly sums up why we're doing this today. Once you really truly master this simple bit of math and what it means for market expectations, your whole mindset shifts. You stop staring at a stock chart and just guessing which way it's going to go. You start looking at the business itself, and you begin calculating what it's really worth. It's a huge shift in thinking, really. It's the difference between being a speculator and being an investor. And it all boils down to this one question that you and every other investor should be asking before you hit that buy button. Are you guessing or are you calculating?